And so for us, selling at IPO or after the lockup expires would have been the best decision every single time, basically. Also, we didn't happen to be in the companies that were like these infinite compounders once they were public. When the opportunity came to sell a company that was very overvalued, doing it was almost every time the right choice. Right? There's almost never a moment where I regretted selling 50%, even when the company kept doing well on a go-forward basis. So take the liquidity when you can, when you're an early-stage investor, because DPI is valued by your LPs. It helps them to reinvest in the fund, and because we're compounding at 30% IR, it's faster than the public markets are compounding. So you're better off reinvesting.
Hello and welcome to Fireside with VC. My name is Andrew Romans, and today we are with Fabrice Grinda, a famous entrepreneur turned VC with FJ Labs. Fabrice, nice to see you.
Thank you for having me.
Yeah. Last time I saw you, you were presenting at our Global VC Demo Day in New York, which was great. It's been a few years since we've met in person. So, Fabrice, you guys are doing, FJ Labs is doing what I think you call angel investing at scale. And you had two very successful companies, unless I'm missing a whole string of others. Maybe mention quickly what those were, and then we'll transition into what you're doing now and what you're learning.
Yeah, I built actually more than two venture-backed businesses, but the two successful ones were Zingy, which was a big mobile content company in the U.S. It was back in the early 2000s. It was a ringtone business. It grew from 0 to 200 million in revenues in 4 years with no VC funding, actually, because there was no VC funding available on 01, 02, and built the old-fashioned way on profits. And I sold that for 80 million in 2004 before we'd fully scaled and did very well. And then in 2006, I ended up building a company called OLX, which to this day is the largest classified site in the world. A company with 11,000 employees in 30 countries, over 300 million uniques a month. And it's the leading classified site in Brazil and all of Latam and Ukraine, Poland, Romania, all of Eastern Europe, in the Middle East and India and Pakistan and all Southeast Asia. It's a huge company which I sold to Naspers Prosus in 2013. And in 2013, went on to build FJ Labs.
What's interesting about that, and what I think is relevant too for founders that want to work with you guys or VCs, is that you look at Craigslist and you think, what idiot made this interface? Like could they make this any clunkier? Like they're doing it on purpose. And then of course they didn't execute across Southeast Asia, Latam, and Middle East and all Europe like you did. So I think that the execution, just soldier combat experience that you have, translates into building your venture firm and working with startups. But so to move to not dwell too much in the past and to move into today, I believe you started investing as an angel investor yourself while you were running companies, and then you got to like over 100 investments, and then at one point, and there's a debate of am I more effective investing only my own balance sheet, or is it better to deal with all this reporting and outside LPs? And every time I write a report to the LPs, I think to myself, maybe I'm a little sharper when I'm investing other people's money, because it forces you to like follow up on every single company, blah blah blah, and all that. But how many? I think you got like Telnor came in for 50 million, right? Wasn't that the first outside LP?
Yeah, so I mean, look, I started angel investing in '98 when I built my first company, and in fact, I thought long and hard, should I do this, right? Like, it's in a way, maybe a violation for my mandate as founder CEO to be angel investing. It's a distraction. But I argue to myself, at least, articulated that if I can articulate lessons learned to other founders, it makes me a better founder. And if I can keep my fingers on the pulse of the market, it makes me a better founder. And so I decided back in '98, as long as it takes no more than 1 hour. So I came up with the 4 selection criteria, which we still use to this day. In a 1 hour meeting, I decide if I invest or not, and I only do marketplaces, which of course is what I was building back in the day, then it's okay. And that took on a life of its own. So by 2013, I was, I think, at 173 investments and doing very well. I'd already pooled my angel investing with my current co-founder at FJ Lab, Jose, and it was going very well. I didn't think I was going to build a venture fund for 2 reasons, I would say. One is the volume of deals we kept getting in kept increasing because of the brand I build in the marketplaces. And I was like, you know what? I'm spending so much money hiring a team and to filter the inbound deals. We get 300 inbound deals per week, and I'm also spending a fair amount of money like in legal, in the back office, et cetera. Actually having more scale in order to pay for the cost structure because the volume at which we were operating, it felt like a fun to begin with. And then all of a sudden, Telenor, to your point, came and said, hey, we want to work with you guys because we now own all these marketplaces and classified assets, and we want a perspective of what's going to happen and what we should do. And thought long and hard about how to best do this. They offered to invest in the holding company, but I'm like, you know what? The more scalable way is just build a venture fund because then it doesn't dilute us whether it's 50 million, 100 million, or 300 million.
And I think I knew you during this time, Fabrice. And back then, before there were podcasts, there were blogs. And I remember, you were a big blogger, and so was I. And I always enjoyed reading your, lengthy blogs that you would write. But I got the impression, and I don't know if we ever talked about this, that one of the motivations to take outside capital was that you certainly see this with your friends that you're just regular angel investing without your scale, with all your exits and focus, is that it takes a long time to get paid. Like it takes a long time to realize the cash, which is, a whole industry, a whole, core to everyone's strategy. How are you getting into secondaries, or how are you, forcing liquidity? But a lot of angels, they deploy a certain amount of cash and then they're surprised to see, damn, I've been in this deal for 14 years or 12 years, or finally it IPO'd and there's a lockup, or it finally got acquired, but damn it, that company's privately held and acquired us with an inflated valuation, and is now, I'm facing a discount if I want to get out. So rather than get discounted there, maybe, was that ever an issue, that just the sheer timing, or were you recycling cash to be able to continue to
No,
be a
I
prolific
didn't.
angel?
It was never a lack of cash. I was recycling cash. It's more two things. It's like I want to, in life, I want to optimize life for doing only the things I like to do. And what I like to do is talk to the very best potential founders that we could invest in. So from every week we go from 300 that contact us to 50 we take calls with to 6 for second calls. So I only talk to those 6 basically. And so in a way, that massive filtering process I wanted someone else to do. Number two, of the portfolio, we have 1,200 companies, which is like 2,000 founders. I only wanted to talk to the very best. And so same thing, I needed someone to like figure out who they were and make sure that I only allocate time to them. And then I didn't want to do anything else. I didn't want to deal with legal. I didn't want to deal with any back office work, etc. And turns out that if I have a fund, I can actually hire for all the positions to do the things I don't like to do, such that I can focus my life on the things where not only am I the most value add, but also that interests me the most, where I can actually keep blogging and thinking through trends, etc. And so there's much more. Can I get the fee structure, enough fees to aid the fact that I was spending several million a year, out of pocket, so maybe cover that, maybe break even, but to actually hire the team to do the things I don't like to do, and that's really been the motivation, and it's worked very well.
Yeah, yeah. And I think like Mao Zedong says, seek truth through facts, which is a very obvious thing to say, but there's something about having primary data. And you've been investing from sounds like 1998, so kind of like .com heyday, the go times, right through all these different cycles. How many investments have you completed that were entry point, and then adding in follow-ons? And then what's your pace per year right now?
Yeah, so the follow-ons, is our follow-on strategy is very differentiated. The beauty of being a small angel, where you write a 300K check in a company, is you don't own that much of it, so you're not obligated to follow on. Right? Like I think what brings down a lot of venture returns is if you did the seed or the A and you own 25% of the company, if you don't do your pro rata, the company dies because it means that you don't believe in it. And so in a way, you're kind of committing already to the follow-on of the next 1 or 2 rounds. And it's not the way, from a theoretical perspective, you should be doing your follow-on analysis. The way we do follow-ons is knowing what we know now of the company, of the team, of the traction, of the valuation of this round. If we were not existing investors, would we invest? And The companies that are not doing great, we don't invest. The companies that are doing amazing, but the price is insane, we don't invest either. So we don't double down on all the other winners. We only double down on the companies that, well, I guess two scenarios. The positive one is companies doing great, the valuation is reasonable, we put more capital, which is about, or the company's not doing great, but there's a pay to play, and we feel the risk reward is worth it to avoid the massive conversion of common, the cram down, or whatever. So occasionally we do those. On average, we follow on 25% of the deals, which is a much smaller percentage, I would say, than most VCs do, which actually I think helps boost the returns. And the way we're structured is we don't actually reserve capital for the follow-ons. We just do them in whatever fund is currently operating because we don't always follow on.
Okay. So no problem investing across funds in a follow-on, which I kind of agree with that, having lived through this myself. And so, how many investments are you making per year these days? And I
So
know that
these
varies.
days, yeah, it's been pretty consistent actually over the last like 5 years. It's 150 new deals a year, basically.
150 new
So
deals a year.
yeah, 3 deals a week.
Okay. And you guys, you said that the four main decision criteria on deciding with this like 1 hour call that gets to you, which is probably the follow up call with FJ Labs.
Correct.
It hasn't changed really since the late 90s. What are these four criteria, or is it still the four?
It's still the four. The number one is do I like the founder? And now, do we like the founder as a team? And by the way, we're 5 GPs and 10 investors in the funds. Do we like the founder? To, it can't be, like poor and oh, I know what a good founder is when I see it. So we've defined it. For us, it's someone who's extremely eloquent and a visionary salesperson, but also knows how to execute. So when we're in the intersection of people that know how to execute and are visionary salespeople, and the way we tease out in 2 1 hour calls, to your point, there's a first call and the second call with one of the partners. On the second call, we check out, do we like the business? How well can they articulate both the total addressable market, but also the unit economics? And we're mostly seeded A investors, but even pre-seed and pre-launch, we want the founder to have thought through, okay, what is their estimated customer acquisition cost? What is the average order value in the industry? What is the margin structure of the business they're in? And so we want to compare CAC to LTV and make sure the unit economics make sense. And so we're very
So,
unit economic driven.
so big advice to anyone taking a call with FJ Labs: know your unit economics, know your margins, even if you haven't launched, and you just got something beneficial to not die on your sword in your first call and never meet Fabrice. Okay,
For
so
sure.
so
Number three, do you want the
and
other?
every VC
Okay.
says management. It's all about the team, but it sounds like you've kind of codified some ways of understanding them. I mean, sometimes you have a CEO that's a bit different, like Steve Jobs, doesn't shower, doesn't wear shoes, a little prickly. To you, who might not be as eloquent as the polished, Jobs that everybody knows today. You might have missed that one. Or do you
No,
think he had the charisma
well,
to recruit the team, raise money, and all that?
the way they dress, the way whatever is not that relevant. That said, we do have a no asshole policy. So if someone comes across as condescending, arrogant, is not going to treat people well, we're not going to invest, right? Yeah, the Steve Jobs or Travis's of the world are probably not people we want to be back.
Okay. 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 And what were the other criteria?
Yeah, so number three, deal terms. Now, nothing's cheap in tech, but is it fair in light of the traction, the team, and the opportunity? And we are price sensitive. And the reason we're price sensitive is if you come in, 5 pre or 10 pre, and the company sells for 50, you actually make your money back. But if you came in a overhyped AI deal at 150 pre anything, then most likely than not, you're not going to make your money back if it's an acqui-hire or whatever. And so we know where the median valuations, we look at the median, not the mean, should be for each stage, and we try to be close to the median. And then number four, is it in line with our thesis of where the world is going? And we have very clear thesis on the future of digitizing B2B supply chains, the future of mobility, the future of real estate, the future of every major vertical. And so we want something that both is useful for the world and that is aligned with our vision of where the world is going.
Yeah, I used to think, oh, this is on thesis for us, and so I only want to invest in this at the moment, and I think of that as offense, and now I've become a bit more defensive. of saying, geez, even my legacy portfolio, we've got like over 70 companies where we're introducing them to other VCs, and they're like, well, this isn't quite as much in line with our vision of the future, right now. So it can almost become, I went from being offensive to defensive on being worried about, investing in a company that we're so contrarian, we're going to have to fund this thing alone, which is maybe not the way our fund is built for.
We look, we totally have that problem, right? We are contrarian, meaning right now we're not investing in the AI LLM companies because we feel that the margins are typically negative, and yes, the revenues go high, but if you give me $1, I give you two back. It's really easy to go from 0 to 100 million in revenues, and so there's so many of these companies with amazing teams, the MIT team, the Stanford team, the Harvard team, et cetera, that have raised a lot of capital at high valuations with no real differentiation. I'm worried that there's going to be a day of reckoning. And so we haven't been doing any of that. Instead, what we've been investing in is marketplaces, especially B2B, that are applying AI in order to be more efficient. But it is contrarian because we're investing in applied AI as opposed to AI itself. And I would argue it's the smart way to invest in AI, but because it's contrarian, getting these companies funded is actually pretty hard. And so we need to be very thoughtful about, okay, do they have enough capital to get to a level of traction that's going to be compelling enough that no matter what, they will get the next round funded. And so we sadly, by virtue of being contrarian, have had to increase our bar and be much more careful.
Yeah. And what have you learned, or what kind of policies have you set in place for runway? And maybe even how do you think about it? We often say, all right, your hockey stick revenue growth that you're forecasting is uncertain, and it's unlikely you're going to grow faster than Groupon or your ringtone company of the past. But what is certain is your operating plan of what you look like you're going to be spending. At least
Correct.
that's and if you give it like a certain amount of runway, you have time to make some changes and cut some wires and splice some wires on changing your spending or your tactic to I'm going to do a 12-month upfront license agreement or something to fund the company through customers. What's your view on runway at various stages that you guys invest at?
Because of the contrarian nature of our investments, where we're not aligned with the general VC thesis, which right now is all AI all the time, we basically need 2 years because that gives you enough time to pivot if you need to adjust it, to grow. You need a 3 or 4x from C to A, from A to B, etc. And so, yeah, 2 years is about the right time.
So 24-month, 2-year runway gives more time for the startup to achieve some milestones, to open the next gate of the next gatekeeper to raise money at theoretically a higher valuation. On the other hand, founders seem to sail awfully close into the wind, in my experience, and they tend to be born coming out of their moms screaming about dilution, and they'd rather put the entire castle at risk to just get a tiny hair shaving of minimizing dilution, which changes nothing. So I think there seems to be a balance in my career that, especially when talking to younger entrepreneurs, or maybe they're not that young in years, but this is their first startup, that they're not, putting enough gas in the tank,
Yeah, for sure.
over that issue.
For sure. But in our case, if you're raising less than 18 months based on your operating plan, we're not going to do this. We've seen too many people fly too close to the sun. And by the way, if I look at like what are the things that kill startups the most, number one is you don't find product market fit. Okay, that's normal. Number two is actually you've raised too much money at too high a price. And many founders are like try to price to perfection, but the problem is if you don't grow in the valuation, you die because no one wants to take the anti-dilution, etc. Or number three, you didn't raise enough capital and you didn't grow as fast as you could, and then you need to do an extension round. Only the insiders can support it. You can't get external capital, and often it leads many people don't want to do bridges, and often the company dies as well. So the 2 and 3, which are actually related to dilution sensitivity, or some of the biggest reasons that companies die.
Yeah. Yeah. I always say that when you're pricing this next round, and we're all contemplating how much money, what valuation, what terms, you should be thinking, what is the next round going to look like after? So does this hilltop get me to the next hilltop?
Exactly.
And don't think of it as, I mean, it's great, especially in rough, unprecedented COVID times, to say we're raising on a path to profitability. So everybody be chill because this gets us to profitability. But when you're building products and you're trying to be a world leader, that's not always going to happen. So a little more on valuation, on what is fair and what has changed. So over the many years, I mean, there was a time when $1 million was the valuation of a company that hadn't started yet and was just going to raise angel money. Then that seemed to have gone to 3 to 5. You think of like the first Dave McClure 500 startups demo day. Everyone was a 5 million cap, right, on a KISS note, on a convertible note. And then some of these valuations are getting bigger. What is fair in your view, and how radically has that changed from the past? You've lived through a number of phases of where the market is. So maybe start with pre-revenue. And how
Yeah,
much pre-revenue are you doing these days?
pre-revenue first-time founder, which is probably also different from a second-time founder who's been very successful the first time, which is also different from a second-time founder who hasn't been successful the first time. But pre-revenue, we actually try to stick to six pre, raising one and a half. Because you can go a lot further with that capital today. And if you're raising the crazy, and again, the AI companies today have been raising at 20, 30, 50, 100, or the crypto companies. We would not do that at pre-revenue. So we don't do any of the YC pre-revenue deals at like the 20, 30, 40 caps. It's just too priced to perfection. I'd rather wait a year or two, see whether they succeed and survive and grow into the valuation, do the next round, then do them out of YC. So I'll go to YC, actually, look at all of them, see the ones that I think were interesting, and then wait until the next round. And then I'll do them in the next round if they've grown into the valuation and the valuation is reasonable and there's a convergence between traction and valuation. And that's pre-revenue. Seed round, and I'll give you and seed round for me is you're doing 15, 20K a month in MRR net revenue. So maybe you're 150K in GMV per month and you're with a 15% take rate if you're a marketplace. Or maybe you're a B2B marketplace, you're doing 500K a month in revenue in GMV with a 4% take rate. So you're at that 20K net revenue margin, and that net revenue you have a very high margin. Then you're raising, again, 3, 4 at 12 pre, which used to be 9 pre or 8 pre, but now it's like 12, 13. And this is where we try to be. And again, this is the median for us. The mean of the market is way, 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 way higher. And the A's, same thing. Net revenues maybe 150K MRR, or if you're a SaaS company, or maybe you have a 750K in GMV, you take with a 15% take rate. And the range we try to be at is you're raising 7 at 23 pre, so 30 post, or 10 at 30 pre, something like that.
So what's the multiple of ARR for those? So what's the pre-money, like if
Well, ARR,
revenue is
the
1
problem is that
million
ARR depends on margin, right? Like, so you're talking
net
SaaS
revenue?
businesses
Say net revenue. So it's like
and
their
net
take
revenue
rate
terms,
revenue,
yeah.
not the
And
GMV.
in the net revenue term, at the A round, they're doing a million, 1.5 million, and we want to invest at 20, 23 to 30, right? Like, so I don't know, 20, 25.
So 20 to 25x
Yeah,
revenue, and that's for the hot growth. I remember when 10 was kind of fair.
yeah. I mean, 10 I think is fair later stage when your growth is lower, but if you're growing 4 or 5x year on year, I think 20 at seed and A, it's totally fine. Especially the market does bear it. What is not fair, though, which I'm seeing a lot of, companies in the AI space raising at 100 or 200 or 300, a million, and we're talking 300x ARR. That is happening today.
Right. And the reality of that is that if a company's got even 5 million of ARR revenue and it's priced at 10x, and so you're investing at a pre-money valuation entry point of 50 million to make a 10x return, which is required to make up from some other losses of some other investments that are not going to work out, to get to like a 5x, 6x fund, you'd have to get liquid at 500 million with no future financings. And
Correct.
if we're doing our jobs well, we're introducing the startup to a million VCs because we know a million VCs, and we're going to get diluted by, they're going to issue 10% stock at least 5 times. if it's going well. So that means you got to exit at $1 billion to make a simple 10x return on a 5 million ARR company that was priced fairly at 10x, and it's probably priced at 20x, these days. It means that we need inflation at the exit counter, that reflects the market caps of Microsoft and such, to make that math work. And that's where being
For sure.
price sensitive, I think, matters.
Yeah, no, it absolutely matters. It also matters on the downside. Like if I look at my portfolio construction, the the first 2% of deals we do like 50x, that's 1x the fund. The next 13% of deals we do 8x, that's 1% that's 1x the fund, and then the next 85% of deals we also do we do like 0.45x or whatever, and that's 1x the fund. And so actually the fact that we are price sensitive means a lot of the companies where they don't do well but they get equity hired, we get our money back. So to date we've had 355 exits. We've actually made money despite being seed and pre-seed investors on 45% of the deals, which is, as a percentage, way, way, way greater than most. And even on the ones that we lose money, we still make 30, 40% of the money back because of that price sensitivity. So from a portfolio construction perspective, it actually works pretty well to be price sensitive. But we probably do lose on the hottest deals that maybe are 1,000x or whatever, because we're not willing to pay up.
And what has changed in your perspective of, I would imagine in the late 90s, we were investing on promissory notes or convertible notes, right? And then sometimes there was a price round. Like one of the angels was like, hey, that's confusing me, too many moving parts. Let's do a straight priced round. And the concern there is what percentage of the fundraise is going to pay the lawyers at Zurich to, issue the stock and all that. But what is your preference on, and what are your thoughts around moving from convertible notes with caps, uncapped notes, to safes, pre-money and post? And I guess the short answer is that if you want to be active in the market making 3 investments a week, you just got to play along with the post-money safes that are the typical.
Indifferent. I do safes at seed, especially, and pre-seed is fine, right? Like you don't want to be spending, your point, time and money on lawyers. Whenever there's a real round, like 7, 8, 10, 15 million, they'll do a price round, so it doesn't matter. And if there's no real round, it means the company failed, so it also doesn't matter in a way. So I don't mind doing safes at all. That said, I will not do uncapped. Otherwise, you're not being compensated for the fact that you're investing today. And so I don't do bridge rounds. I don't do uncapped. It has to be capped. It has to be capped at a price that I deem fair relative to traction, team, opportunity.
Right. I mean, I always use the example explaining that to a founder saying, okay, so imagine Lady Gaga is going to invest in your startup on an uncapped note, and then she tweets about you. She's got more Twitter followers than Obama. And then all of a sudden you get 100 million downloads. So you're the next Skype. The more she helped you, the more she diluted herself in her ownership in your business. So if you want a purely passive investor, maybe that makes sense. But if the investor believes somehow that they're going to help add value, like a Lady Gaga in that situation, then the uncapped note is just shooting your toes off.
Absolutely.
Yeah. Sometimes there is a situation where Sequoia is coming in and they're not going to honor pro rata equity rights or something like that. And
yes,
like I've said never, ever, never, never, never do an uncapped note. And there have been a few odd moments in my life where I did it and I was happy I did it, but I'm religiously against it.
But there's been moments where I did it, for the exact reason you said. Oh, Sequoia and Andreessen are coming in. They won't let anyone else in, so might as well put the money in now. And then the round didn't happen, or they pulled off, and then I invested in an uncapped note, and it failed. So part of the reason I hate doing bridges, because it can't be a bridge to nowhere. I much prefer to pay 20% more and have the company fully founded for their business plan.
Agreed. Okay, and marketplaces. So obviously you've got the marketplace DNA more than most people that are on an investment committee anywhere in the world. And so it makes sense that this is the sport and that you're good at. At the same time, the internet has evolved a lot since 1998 and the 2010s and all of this, and since you've taken on hundreds of millions of dollars of LP capital. What is the state of marketplaces being of interest to a person like you, since you know so much about it? And what's the good, the bad, and the ugly of marketplaces, since it's rare to have such an expert on this topic?
Yeah, so first, the good, the bad, and the ugly. The good is their winner takes most. So if you invest, which is also the bad, by the way, if you invest in one and it does amazingly well, you win. You kind of have a natural monopoly. It becomes huge. And it can be extremely capital efficient to get there because you get the network effects. Now, the downside, of course, which is also the ugly, is if you lose, there's probably zero value, um, and you're nowhere market share wise. And if you have two that are fighting for it, they may fight to the death because being number two is worth nothing. And so you're better off like merging in some way, shape, or form. And the chicken and egg problem that needs to be solved, has its own incredible, interesting dynamic. That's one I'm actually very well suited to fixing and helping the founders figure out what they should do, how they should build liquidity, what markets should go after, how they scale. Because actually, there are clear mistakes that founders make, like they have way too much supply, not enough demand, so their balance in the marketplace is not balanced because it's easier to get supply than demand. But they're beautiful businesses. They're asset light. They're winner takes most. If you win huge. And they end up being bigger than you think in all these different niches. Now, the way it's evolved, because many people are like, wait, why are marketplaces relevant in 2025? And that's because you're thinking about it from your consumer hat on. As a consumer, if you look at your needs, they're being met by marketplaces. Amazon, by the way, is mostly a marketplace. You can get any item you want in 2 days. Uber Eats, DoorDash, Uber itself, Airbnb, Booking.com, all these things are marketplaces, and they meet all of your consumer needs with like 25% penetration. And yes, at some point it'll be 75% penetration, but that's like a 3x from where we are. So that's not necessarily super compelling. There's still new things that are coming up, like live shopping is becoming a bigger trend. But I think what's much more compelling is the fact that if you think of the B2B world, and frankly the government world, the public services world, it's completely non-digitized, right? Like imagine you want to buy petrochemicals. There's not even a catalog of what's available, let alone a system or a place where it's connected to the ERP systems of the factories to understand manufacturing delays and capacity. There's no online ordering, no online payment, no tracking, no financing. Everything needs to be done. And this needs to happen in every industry, in every geography, for every type of input, and both finished goods and intermediate inputs. Whatever, raw materials like cement or whatever. In addition to that, think of SMBs. Most SMBs, and frankly, many big companies still run like pen and paper or Excel at the best. And so the digitization in most industries and most small businesses is de minimis. We're sub 5%, often sub 1%. And it needs to happen. And the best way to do it is actually through marketplaces. And so my current thesis, and we have 6 sub-theses in that, is all around digitizing B2B supply chains using scalable marketplaces. And it's not sexy, but these are huge, right? Most of the GDP of most countries is a combination of public services and enterprise.
Yeah, and you could probably look at one country and figure out what those top industries are and go after them. So, what are some examples you can share that have been marketplaces funded in 2025 as we're coming to the end of the year here?
In 2025, well, this
Or
year
just
I've actually
recent
been
times.
studying.
What are some recent times marketplaces that made sense?
Well,
Because
I'll give you a few that are already scaled that are larger B2B marketplaces. So I'll talk in SMB enablement, and then I'll talk in industry writ large. In SMB enablement, there's a company called Slice, and Slice basically does the back office operations for pizzerias. So imagine you're Luigi and you want to cook your little pizza. That's what you create a pizzeria because you like talking to your customers cooking pizza. And then all of a sudden, as an SMB owner, you end up picking up the phone, managing a delivery fleet, getting supplies, doing accounting, negotiating with Toast, negotiating with Uber Eats and DoorDash. I mean, this is not the life you signed up for. And so Slice will pick up the phone, create your website, manage the delivery fleet, organize online ordering, and do basically all the back office and provide a POS. And they now have like 20,000 pizzerias on platform. They're doing over $1 billion in GMV. And the same thing is happening in other verticals. So we're in Chowbus, which is a POS for Chinese restaurants. We're in Fresha, which has I think 70,000 plus hairdressers, where they manage the seats for the hair salon owners, and then for the hairdressers, all their underlying customers, and they provide a POS. Or at least that's the business model for it, even though it's a marketplace between the customers and the hairdressers and the barbershops. Sense, CNTS, is a marketplace to help the laundromats or the dry cleaners manage delivery fleets, get their supplies, provide a POS. We were in Moments doing the same for people that are organizing managing yoga studios. So this is happening vertical by vertical, and many of these are big. I mean, Fresha is in the billions in GMV going through the platform. Now, in terms of digitizing inputs, big companies like Nodi is doing it for petrochemicals. Where in Shootflix in Germany, which is a three-sided marketplace between the quarries providing gravel, the construction sites, and the truck drivers delivering it to the construction sites. But even things like ShipBob, which is a last-mile picking and packing marketplace, helps companies who don't want to build their own distribution networks a la Amazon, work and have same-day delivery or two-day delivery. So basically, the entire stack is seeing very large companies. And ShipBob, same thing, multi-billion-dollar company. Flexport also falls in that category of B2B marketplace as a digital freight forwarder. So there are a lot of really interesting companies that are being built. We're investors in Formic, which is a marketplace helping, and I think we invested this year, which is helping companies automate their production lines. They go in, they send people, figure out which robots you should be buying. They help you, they lease them to you, they do the installation, all in a marketplace model.
Okay, and I can imagine that. And what are acceptable take rates in these marketplaces that you've seen over the years? Because some of these B2Bs could grow really quickly. If you're digitizing oil and gas rigs and
Yes.
you're getting it off of Excel and post-it notes.
So this is one of the things you need to be very careful in B2B marketplaces is you need fragmented supply and demand, and if you have too much consolidation on either side, you may not be able to take a take rate at all. Which is why the companies that are like trying to do food ordering for restaurants, ordering from the suppliers, doesn't work in the US because you have a company called Cisco, which is 50% of the market. You're going to be a distributor, you're not going to be a marketplace. So it depends on elasticity of supply and demand. You try to have like 3%, let's say, but there are many categories where you cannot take a take rate, in which case you have to, even though you're a marketplace, your business model is going to be the POS or the factoring or, or the financing or value-added services or insurance, etc. So it really depends, or a SaaS fee for providing a tool to one side or the other of the market. Take rates vary. You try to have 3 to 5%. Sometimes you can go, some categories which are not commoditized, you can go to 15%. But I'd say the difference with the consumer side marketplaces is on average, the consumer ones are probably at 15%, and probably on average, the B2B ones are like at 4%. But then you add a lot of other things, like you sell ads, you have a B2B SaaS tool, et cetera, et cetera.
Yeah, when we've been in some of those, it was, I felt, thank God, to see these other services layered on top. So that relatively small take rate of the, $100 of revenue delivering 3 to 5 didn't feel great, but seeing it creep up with some others was good. On the other hand, fintech looks really exciting until you've done a lot of fintech investing and realize, I didn't bring, a nuclear weapon to this gunfight. Like, I needed a bigger fund to support the growth of one of these companies.
Absolutely.
To be able to regulatory, banking, crazy stuff. It's like regulatory capture. What have you witnessed, good and bad, on seeing your marketplace companies over so many decades get into factoring, so like advancing cash flows or providing financing, insurance?
Yeah.
I think insurance could be good. In some of these cases.
It depends in the category. In general, to your point, fintech, the problem with needing with financing is you typically have a bank, or it starts with a hedge fund or whatever, family office, eventually a bank. The problem is the more they want you to put collateral, and so as they scale the amount they lend, you need to have more equity. And so if you don't have the fund size to support putting more money as they scale, it is difficult. And also right now it's reasonably out of favor. No, the business models that I think have been more compelling than factoring in B2B have been things like actually selling ads to like self-service ads. So we're investors actually in a marketplace called Top or a company called TopSort. TopSort helps marketplaces sell ads to their own sellers who want to be promoting themselves to the marketplace. And this is beautiful because advertising has a 95% margin. And so if you can get 3, 4, 5% of your GMV equivalent in advertising, it is a super profitable endeavor. And by the way, Instacart makes most of their monies through self-service ads where the brands are buying ads. Amazon now is
Yeah,
a
I was going to say
multi-billion dollar
Amazon. I
business.
remember
Yeah,
the first time Amazon did this, people were like, "Why are you promoting your competitor on your website?" And I'm like, "No, this is genius. They're now getting paid without going to work. Compared to what they had to do to like buy the book, sell the book,
yeah.
store the book, deliver the book."
And by the way, they're actually selling the ads not a competitor. They're selling the ads to people within. Well, I guess you consider the other suppliers competitors, but they're selling ads to sellers on their own platform. And so
In the
these
very
self-service
beginning, though, if
ads
you remember, in the very
are
beginning,
genius.
when
Yeah, yeah,
Amazon first did this, everyone was scratching their head and then said, "Actually, although this is counterintuitive, this is actually genius." And
yeah,
then
because
it
they were
just like
first party first. I mean,
became
people don't realize
unstoppable.
Amazon is really a third party platform. They're really they're really a marketplace.
Yep. Okay, so maybe getting out into closing out this session here today. Exits. So you've seen a lot of exits. At this point, you could probably, if you were writing a book on these are the 4 different types of exits you get. What are the different categories of exits that you've seen, and a little bit of what's the good, the bad, and the ugly of seeking truth through facts that you've seen so much data yourself?
So I'd say there are three types of exits. Well, I guess four. The bad one. You have M&A, you have IPO, you have secondaries, and you have the company shutting down. What's interesting is these change dramatically based on a combination of the general macroeconomic cycle and actually the venture cycle, right? Like so in 2021, there was an insane number of IPOs, insane number of M&A, and that completely went by the wayside 22 to 25 basically. And so 22 to 25, the vast majority of exits we got were secondaries. And these secondaries obviously can only happen to companies that are doing very well, either in the up rounds or they got so big that there was a secondary market that has started to be created on platforms like Forge, where you have secondary brokers that come and approach you to buy and sell the companies. And so I'd say secondaries have been the category that's been growing the most and where we've been doing most of the exits in the last 2 to 3 years, in a combination of up rounds and companies that are doing really well but we feel are overvalued. And again, most VCs will not sell on the way up, but we, because we're seed investors and companies are staying private longer and longer, if we feel that something is so priced to perfection that we're not going to be underwriting a 10x, because the point you said earlier is we really need a 10x on a go forward basis to justify keeping investing, we try to sell 50% of the way up. And 50% is our rule of thumb because it's a no regrets philosophy. We already booked it at whatever 10x, and we're if it goes to the moon, we still have 50%. We're happy. If it goes to zero, we already have 10x. We're happy. And so 50% is what we do most of the cases,
At 10x,
except
if the company is, if the share
well,
price is
it's
10x,
not really multiple driven. It's much more how price for perfection do we think this is, and what do we for us to invest in a company at any point in time, if it's a later stage like Series B or C or D, which is the ones that are typically getting the secondaries, we need to still see a potential 10x because it's as though we're investing in this round. And if we don't see that, at the very least, we need to say, okay, there's a 70%, 60% probability of a 2, 3x with high probability, like a high conviction we get already back, big probability of 3x, and at least a 20% probability of a 10x. If we don't see that, we often will sell if it's only a 2, 3x. We're not PE type guys, right? Like we're not trying to get 15, 20% IR or whatever.
and what mistakes would you say you made in secondaries? So looking back on so much activity, you must be learning from something not going the way you thought, or the wind shifted on you in the middle of it.
Yeah, most people think you should be holding forever and you should be becoming crossover funds, et cetera. I mean, I think, and that's what definitely the larger funds are doing, but I think that'll lower your IRR. Most companies that have gone public with market caps below 20 billion, I would say have not done particularly well in the public markets. And so if we could have sold in the IPO, I mean, often we couldn't, we were blocked up. We were way better off selling in the IPO if we could have, or right before in a secondary, then holding through lockup. We've mostly lost money in the 6 month during the lockup for most companies. And then if you look at should we have held the stock forever, the answer is really a dichotomy. If the company is one of these that is a category winner in a huge category, the answer is possibly, but the thing is there's only very few of these, right? Like it's like Google or Microsoft, etc. 99% of the companies we're better off selling as soon as we can once the company is liquid, and reinvesting because it compounds at a lower rate once it's public than before. And also, we are not public market investors, right? Like all of a sudden when the company is public, I lose my privileged access to the founder, right? Like before they're public, we're having like update calls and I get all the financial, the strategy and everything. Like the minute they're public, that goes completely away, especially given that I had that 0.1% of the company. And so for us, selling at IPO or after the lockup expires would have been the best decision every single time, basically. Also, we didn't happen to be in the companies that were like these infinite compounders once they were public. When the opportunity came to sell a company that was very overvalued, doing it was almost every time the right choice. Right? There's almost never a moment where I regretted selling 50%, even when the company kept doing well on a go-forward basis. So take the liquidity when you can, when you're an early-stage investor, because DPI is valued by your LPs. It helps them to reinvest in the fund, and because we're compounding at 30% IR, it's faster than the public markets are compounding. So you're better off reinvesting.
Got it. Got it. And do you guys ever sell 10% or 25%, or it's really 50 or nothing?
It's 50, 90% of the cases. It's 25%, maybe 5% of the cases, and it's 75%. 5% of the cases, because in these two cases, in the 25% is like the company's doing great, it's really priced high, but we understand the story, we see why it can grow into it, we see enough, it's compelling enough, and maybe the multiple is just too low, it's only 3 or 4x, that we want to keep 75%. Now if it's 100x AR plus, it's so priced to perfection that then we try to sell 75%. But that happens in very few companies. It only happens in the very hottest of companies. And those are the cases where we try to sell 75%. So right now we're trying to sell 75% of our AI companies.
So sometimes we look at, well, where are we on this fund? Like we invested out of fund 1, fund 2, fund 3, fund 4. And, are we at 1x DPI? If we're not, maybe we're going to sell 75%. And then let's just solve that problem. No one's complaining. You've all got your money back. And that pushed us to do, well more than, say, 25. That's been a consideration too on our side.
Yeah, that's true. And how long into also, but I could also see the opposite case. Like we already did 1x DPI, and the only way this is going to be 3x fund is if this company keeps compounding, and so maybe we're better off holding. And it's the only compounder, and so we're better off holding or selling less.
Exactly. And I feel like if any LP is complaining, I'm like, hey man, you got your money back, so don't complain.
Exactly.
If I hadn't given you money back, I'm willing to listen to more of this. But at this point, let us do what we're doing. We need that thing to deliver at this point, and these guys are excited about their 4x on this big valuation. That's looking high conviction 4x from here. And so on closing out outside of marketplaces, can you share any of your other core investment themes of what you're excited about?
So look, I'd say, so first of all, applying AI to all these things is key, but not in the way that people expect. So for instance, one of our marketplaces that is crushing the most is a fashion marketplace called Vinted. And what they've done is they use AI to translate the listings between countries and to translate the conversations between users such that for the first time ever, you have a true pan-European, United States of Europe marketplace where the buyer may be in France and the seller in Lithuania, and neither side is aware of it. And it's created massive liquidity, allowed them to win in so many different countries. They're at a 10 billion in GMV. So one, like doing cross-border with AI. Two, simplifying listings where you take a photo and boom, you get the title, the price, the description, the category, all automated for you. And three, like completely simplifying customer care. Now, other things in general that I'm liking, other than using AI to make all these things way more efficient, which I think is the smart way to play AI, is all the infrastructure that goes around building these marketplaces. So, like humanoid robots, payment rails companies, and also things aligned with like different geopolitical shifts, right? Like, so right now we're in Cold War II between China, Russia, Iran, North Korea on one side, the West on the other, and maybe India in the middle. All the companies in the world trying to move their supply chains out of China. And so we've been investing in B2B marketplaces in India that are helping Indian manufacturers sell into companies in the West. So we're investors in like a company like Ziyad, which is helping um, uh, big brands in Europe and in the US buy from little mom and pop companies in India like apparel. And the thing is, any of these manufacturers in their own, they can't answer RFPs, they can't deal with customs, they can't do prototyping. So the marketplace does it and then and sells it to whatever H&M and Zara. And so we're doing a lot of these that are aligned with like the trends of our time. So infrastructure support for the digitization of B2B, which I think we're day zero of. And so this is like 10 years ago. And productivity, there's so many productivity improvements because of AI in all of these categories. To me, this is like the most exciting. So for instance, I would build an AI, instead of building like an LLM, yet another LLM for coding, like how can I use AI to like simplify construction? Like apply for all the permits and manage the conversations between the general contractors and the subcontractors and the architect and the client, etc. I mean, there's so many uses that you can do to make these industries, which are ginormous, more efficient. I'm so excited for all that.
Right, right. And this is all just a natural progression of digitization of what is happening. Automate human
Exactly.
workflows, tap into data sets, get the data to go into a data-driven decision. That was that automated software and reimagine the whole thing.
Exactly.
And guys like the Samwer brothers and you, I would say, have done very well executing internationally. On what was happening just in the U.S. How do you feel about what's your experience of investing outside the United States? And you're originally from Nice, I think, right? So, what's your perspective on getting your ass handed to you in India, or you invest in the India company and then you never hear back from them, or what's your experience on the good, the bad, and the ugly of
Yeah.
international versus U.S.?
So first of all, most of our investors in the U.S., right? Like the majority of our investors. So we mostly invest in new disruptive business models in existing categories. Our idea arbitrage was maybe a bigger part of our theme in the 2000s and early 2010s than it is now. Now it's all the beauty of the U.S. So in general, I would say the U.S. is the best market possible. It has 350
Yeah.
million rich users that are early adopters, that are not so price sensitive. As a founder, you're playing their game of startups in easy mode. Everything's easier: building a company, hiring people, firing people, raising capital, exits, etc. That said, there are interesting, unique opportunities in other markets, but I would focus on the large markets. So I would only do like Brazil and India or whatever Europe writ large, and I would avoid the tertiary markets. So we've done very well in India, we've done very well in Brazil, but if you go to Kenya, it's way riskier because the things you take for granted about what works and what doesn't work don't always work, and sometimes the founders disappear, and maybe the numbers were fake, etc. So I would be way more cautious about investing in frontier markets, and also the geopolitical changes, right? Like we used to invest a lot in the 2000s in China and Russia. But then both of these countries made geopolitical decisions that made us exit the countries completely. I was an
Right.
early
Right.
investor in Alibaba, and now we don't invest in China anymore.
Final closing question. So, Fabrice, I know you tend to bounce around the world a little bit. Like you operate a few months of the year in different parts of the world. Tell us what that is. That's always fun to hear.
Yeah, so I find that I'm trying to optimize life for having the best life possible, and I find that each location serves a certain purpose in my life, and is a best time period to be there. So, for instance, New York, which is where I'm based, is a haven of intellectual, social, artistic, professional activities, and it's amazing. Like whatever it is you're interested in, you will find it pushed to its utmost limit in New York. And there's the smartest people, most ambitious people in the world. The thing is, after 2 months in New York, I'm really burnt out because you're doing so much, and every social meeting is also a professional meeting. And so and there's also a period where New York is amazing. I love being in New York in September and October and April, May, June. But New York is not compelling July, August, and not compelling November through March. And so I balance my New York urban hard charging life with from a work-life balance perspective with going to a beach, which is in this case right now Turks and Caicos, where I am right now actually. I'm there November, December, and typically March, where I'm doing Zoom calls during the day, and that's the privilege of being in a business where I can work remotely. But then in between meetings, I go kite surfing. In the evenings, I go play paddle. I play tennis, and I try to be super healthy. And it provides my beach relaxation haven of serenity destination, and then I balance that with the mountains, where I go backcountry skiing in January, February, and I go hiking and camping in August. And so I go in Revelstoke in British Columbia, which is in like middle of nowhere Canada. And again, same thing. During the week, I'm working, and then every weekend I go either skinning or heli skiing in January, February, and go hiking, camping in the summer. And then I go see my family in Nice and Saint-Tropez in July for a couple of weeks, and then I go to Burning Man every year. And then in addition to that, I try to add a crazy 2-week off-grid adventure, like walking to the South Pole, pulling my sled, like crossing Costa Rica and mountain bike from Atlantic to Pacific, where I'm completely disconnected from the world for 2 weeks to recharge. It's kind of an exercise in gratitude of realizing how survival used to be a full-time job, and when you live off grid with no toilet, no electricity, no water, etc., and you come back, you're so grateful for the little simplicities of life, like a toilet or running water or a hot shower or a pizza. We are so privileged, and we don't even we take it for granted. We don't realize how lucky we are.
Yep, I love it. Okay, Fabrice, great seeing you. Thanks so much, and hope to see you soon.
Perfect. Thank you.
Bye for now.